All right, before we actually get into how to genuinely start taking and placing trades and making money off of this session liquidity model, we need to understand the entry trigger. And we use one simple entry trigger on one time frame. We use an IFVG entry model. But before we get into an IFVG entry model, you have to understand what a fair value gap even is. Now, there are different words for this. Sometimes it might be called an imbalance, right? And what are they and what do they look like? Well, I'm going to give you a crappy drawing of how I think they look like, and then I'm going to show you on the charts, right? An imbalance is a 3-candle pattern, right? And it's a sign of displacement. Whenever you get an imbalance, it should look something like this. Let me see. You have a candle like this, and it expands like this. From the first candle's wick to the bottom of this candle's wick, this in here is a fair value gap. Why is it important? It's all theory. Nobody knows for sure, but I use it and it seems to work. Is that in a bullish candle, in a bullish sequence, right? We expect this candle, that we expect price to trade down into the FVG and trade out of it. So, continue the same pattern of breakup structure or whatever. Because I'm teaching you all this stuff on the fly, let's find where an imbalance genuinely worked, right? Okay. So for example, right here. Why is this an imbalance? There's this candle right here. Then there's a second candle and there's a third candle. If we take this, if we delete this, right? This right here is a fair value gap. And what do we expect from this fair value gap? We expect this gap to hold like this and take price higher to give us another break of structure. This is what we know as a bullish fair value gap. And then a bearish fair value gap is the exact opposite. But let me show you how the bullish fair value gap works first. The next candle trades into the bullish fair value gap. And then we start to trade higher. So what did price do? Traded into the fair value gap, did a little dancey dance. Boom. Fair value gap. That's the thought process behind when somebody says fair value gap, FVG, imbalance, or whatever. Then there's another fair value gap down here. Obviously, and you're like, but price didn't trade into this one, or whatever. This is the part about trading that you need to learn how to be able to use discretion to your advantage. Is price more likely to trade all the way lower to this gap? Is price more likely to trade all the way lower to this gap? You can have multiple fair value gaps in one leg, and then you use your discernment and realize which one that price trades from. But this is a bullish fair value gap, and let me show you an example of a bearish fair value gap. This, ladies and gentlemen, this is a bearish fair value gap. So what do we expect from a bearish fair value gap? We expect this, right? From a bearish fair value gap. This is what bearish fair value gaps should do. Now, remember when I put the I in front of the FVG? That means inversion fair value gap. And an inversion fair value gap simply means that instead of price doing this, it failed and did this. So what a fair value gap that was supposed to take price lower ended up being disrespected and became what I like to call an inversion fair value gap. Boom. But now let's put something into context here, right? I like that I'm actually using this example. I just put up a random example on the screen. I like that I'm actually using this example. Why? Because this shows you what it means to truly read price and know what order flow we're in, right? Guys, what is this here? This is a bullish fair value gap. Why is this a bullish fair value gap? 1 candle, 2 candle, 3 candles. The high from this candle is right there. The low is right here. Price respects this bullish fair value gap, but disrespects this bearish fair value gap. This is indicating that we are still technically bullish. So now I can expect for bullish fair value gaps to hold like this one, and bearish fair value gaps like this one to fail. When a fair value gap fails, it is known as an inversion fair value gap, right? And when price gets inversed, that's an indication that we are in the opposite order flow. So if we have a bearish fair value gap here and we inverse it, that's an indication that we are in bullish order flow. If we have a bullish fair value gap here and we respect it, that's an indication that we are still in bullish order flow. So if we are bullish on a day, we want to see bullish fair value gaps hold and bearish fair value gaps get inversed. That will let us know what side of the market we're on. We don't predict anything around here. And how my model works, the session liquidity model, we do not predict nothing. I let gold or price, I say gold a lot because that's all I trade, I let gold tell me what it wants to do. I'm not predicting it. I'm simply just watching it. If we inverse the gap, I take it. If we're respecting bullish order flow, inversing bearish order flow, and I'm bullish on the day, I'm in that. That, ladies and gentlemen, is fair value gaps and inversion fair value gaps in a nutshell. I'll see y'all boys in the next video.